Do you want to earn money from the stock market? If yes, then you're in the right place. This is the world of stocks and shares, a marketplace where fortunes are made and sometimes lost. It's a world of high stakes and high rewards where the right decisions can lead to incredible financial gain. But it's not a game of chance. It's a strategic dance requiring knowledge, insight, and a keen understanding of how markets operate. The stock market is a vast, ever-changing entity, a global network of buyers and sellers trading shares of publicly listed companies. It's a place of potential where smart investments can yield significant returns. But it's also a place of risk where uninformed decisions can lead to financial loss. It's a balancing act of reward and risk, and knowing how to navigate this landscape is key. Stay tuned as we dive into the 10 rules to earn money from the stock market. Rule 1. Understand the basics. Before you dive into the stock market, you need to understand the basic principles of investing. It's like learning to swim before plunging into the ocean. Knowing the fundamentals is key to navigating the financial waters. First, let's talk about stocks. Essentially, buying a stock means purchasing a tiny piece of a company. As the company grows and prospers, so does your investment. Conversely, if the company struggles, your investment may dwindle. Next, bonds. When you buy a bond, you're essentially lending money to an entity, be it a corporation or the government. In return, you receive periodic interest payments and the return of the principal amount when the bond matures. Dividends, on the other hand, are a portion of a company's earnings paid out to shareholders. It's like getting a slice of the profit pie. Understanding these basics can help you make informed decisions and avoid common pitfalls. It's a crucial step on your journey towards financial success. Scene script. Rule 2. Start early. The sooner you start investing, the more time your money has to grow. Let's talk about a miraculous concept known as compound interest. Imagine a snowball rolling down a hill. As it moves, it picks up more snow, growing larger and faster. That's how compound interest works. The interest you earn on your initial investment starts earning its own interest, and this cycle continues, expanding your wealth over time. Now, what does starting early have to do with this? Well, the earlier you start investing, the more time your money has to roll down that hill, picking up speed and size. Each year you delay could mean a significant reduction in your potential returns. In the world of investments, time truly is a powerful ally. So don't wait for the right moment. The right moment is now. Because, in the end, the most important factor in your investment journey is not timing the market, but time in the market. Remember, time is money in the stock market. Rule 3. Diversify your portfolio. Don't put all your eggs in one basket. This old adage rings especially true in stock market investment. Diversification is the strategy of spreading your investments across a variety of assets to reduce risk. Imagine a seesaw with your investments on one side and risk on the other. As you add more diverse assets, the seesaw becomes more balanced. By not tying your fortunes to a single stock, you're less likely to suffer significant losses if that particular stock takes a nosedive. And it's not just about reducing risk. Diversification can also increase potential returns. You're casting a wider net, so to speak, increasing your chances of catching a high-performing stock. Think of it like a buffet. You wouldn't just fill your plate with one dish, would you? No, you'd want a bit of everything to ensure a satisfying meal. In the same way, a diversified portfolio is a smorgasbord of different investments, each with its own potential for profit. Diversification is key to a balanced and risk-managed portfolio. Rule 4. Do your research. Never invest in a company you know nothing about. Sounds simple, right? But you'd be surprised how many people skip this crucial step. It's like walking into a maze blindfolded, hoping to find the exit. Let's break it down. What does research mean in this context? It means understanding the company's financial health. Are they profitable? What's their debt situation? What about their cash flow? Next, look at their business model. How do they make money? Is their revenue stream sustainable in the long term? How do they stand up to competition? And then there's the market position. Are they a leader or a follower? What's their growth potential? Doing your research isn't about finding a sure thing. There's no such thing in the stock market. Rather, it's about reducing the risk of a bad investment. Remember, investing isn't gambling. It's a strategic game. And knowledge, my friends, is your most powerful tool. Knowledge is power when it comes to investing. Rule 5. Don't follow the herd. Investing isn't a popularity contest. In the world of finance, there's a common tendency to follow the crowd. People tend to invest in what's popular or what's currently trending. But here's the catch. Just because everyone is doing it doesn't mean it's the right thing to do. Following the herd can often lead to bad investment decisions. When you simply follow the crowd, you're not relying on your own understanding or research. You're letting others' actions dictate your financial future, and that's a risky game to play. Instead, encourage independent thinking and decision-making. Take the time to understand the market, do your own research, and form your own perspective. Remember, the most successful investors are those who think differently, who go against the grain and make their own path. So, don't follow the herd. Be unique. Be independent. Make your own decisions based on your research and understanding. Rule 6. Be patient. Rome wasn't built in a day. Now, let's take a moment to ponder on this ancient adage. It's a simple reminder that great things take time. This couldn't be more true when it comes to the stock market. The stock market is not a sprint, it's a marathon. It's a game of endurance, of steady growth over time. You can't expect to invest today and wake up a millionaire tomorrow. It takes time for investments to mature, for companies to grow, for market trends to play out. There's a reason why the most successful investors in history, people like Warren Buffett, preach the gospel of patience. They understand that the stock market rewards those who wait, those who resist the urge to panic, sell at the first sign of trouble, those who give their investments the time they need to truly flourish. So, remember, when it comes to the stock market, haste does not make wealth. Patience is a virtue in the stock market. Rule 7. Regularly review your portfolio. Don't just set it and forget it. Investing in the stock market is not a one-time affair. It's an ongoing process that requires constant attention. Think of your portfolio as a garden. You wouldn't just plant seeds and then neglect them, would you? No, you'd water them, prune them, and make sure they're getting enough sunlight. Similarly, your portfolio needs regular reviewing and adjusting to meet your financial goals and adapt to ever-changing market conditions. This could mean rebalancing your asset allocation, adding new investments, or even letting go of underperforming stocks. Regular reviews can help you identify trends and make informed decisions. They allow you to capitalize on potential opportunities and minimize losses. Remember, the stock market is dynamic. What worked yesterday might not work today. So, make it a habit to review your portfolio at least once a quarter. Stay informed, stay flexible, and most importantly, stay engaged. Regular reviews can help keep your portfolio on track. Rule 8. Don't panic. The stock market has its ups and downs. It's like a roller coaster ride, thrilling, full of unexpected turns, and it can be a bit scary sometimes. But what's crucial is to keep one's cool. Just as a roller coaster ride is not for the faint-hearted, neither is the stock market. You see, the market is a living, breathing entity, reflecting worldwide economic activities. It's bound to fluctuate. But let me tell you a secret. These fluctuations, these ups and downs, they are your friends, not foes. When the market is volatile, it's easy to make rash decisions. Fear and greed can cloud our judgment, leading us to make moves that might not be in our best interest. But remember, panic leads to poor decisions. Keep your emotions in check, stay informed, and make rational decisions. The market rewards those who stay calm and composed, even during turbulence. So the next time you see red on your screen, don't panic. Stay calm and invest on. Rule 9. Invest what you can afford to lose. Don't bet your life savings on the stock market. This rule seems straightforward, yet it's often overlooked. Investing is not a ticket to overnight riches. It's a long-term game that requires strategy, patience, and a certain degree of risk. When we say invest what you can afford to lose, it means that the money you're putting into the market should not be funds that you rely on for your daily life or future security. This includes your emergency savings, retirement funds, or money set aside for significant expenses like education or housing. Investing should be done with surplus funds, money that if lost wouldn't drastically affect your lifestyle or put you in financial distress. Remember, the stock market is unpredictable, and while the potential for high returns is enticing, the risk of loss is equally present. So, before you dive into the world of stocks and bonds, evaluate your financial situation, understand your risk tolerance, and invest accordingly. Invest wisely and responsibly. Scene script. Rule 10. Seek professional advice. It's okay to ask for help. Navigating the stock market can sometimes feel like trying to sail through a storm without a compass. The waves are high, the wind is wild, and it's hard to see the way forward. That's where professional advice comes in. Financial advisors have the compass you need. They have the experience, the knowledge, and the tools to help you chart your course. Especially for beginners, the stock market can be a daunting place. It's like a vast ocean filled with unknowns. But remember, every seasoned sailor was once a novice. They learned the ropes, weathered the storms, and you can too. Financial advisors can guide you, offering you their expertise. They can help you understand the trends, weigh the risks, and make informed decisions. They can help you set your financial goals and devise strategies to achieve them. Professional advice can provide valuable insights and help you navigate the stock market. And there you have it, 10 rules to earn money from the stock market. Let's do a quick recap. Understanding the basics of stock market investing is your foundation. Starting early gives you the advantage of time. Diversifying your portfolio helps you manage risk. Doing your research keeps you informed and ahead. Avoid following the herd. Carve your unique investing path. Patience is key in this game, as good returns take time. Regularly reviewing your portfolio keeps it aligned with your goals. And remember, panicking only leads to hasty decisions. Only invest what you can afford to lose. This way, you safeguard your financial health. Lastly, don't shy away from seeking professional advice. It can provide valuable insights and guide you in your investing journey. These 10 rules are your guideposts on the road to successful stock market investing. Remember, investing is a journey. Equip yourself with knowledge, stay patient, and happy investing.